Yo guys, what is good? I hope you're all doing absolutely amazing and are trading safely in the markets. It's your boy VGOK here and I'm back with another video. So welcome to this next educational video in which we're going to be looking at convergence and divergence and how we can implement it to our smart money trading plan. So as you guys can see, these are going to be the main aspects we're going to be exploring. I'm going to be going over the two different types of convergence and divergence that exist and also looking at how it actually relates to the Wyckoff analysis and a whole bunch of chart examples for you guys as well. So without any further delay, let's get straight into it. So there are actually two types of convergence and divergence. Now the first type that I'm going to be going over is called what's known as price divergence. So basically, if a difference is seen in the market structure of two correlating pairs, you can actually determine whether convergence or divergence actually exists in the market. So some examples of some correlating pairs, just as an example, are you've got GBPUSD and EURUSD correlating together, AUDUSD and NZDUSD correlating together, GBPAUD and GBPNZD also correlating together as well. These are just three random examples which I've come up with, but there is actually a separate website which gives you the major sort of forex correlations. And if you head over to Google and type in my FX book correlation, and click that first link, now what this page you can actually do on here is you can actually filter and see which currency pairs you want to be comparing. So click those little three dots, click the ones that you want to be comparing. So obviously for myself, the main pairs that I like to trade are GU, GJ, EU and EJ, and obviously there's no US30 on here, but you can add in other things like gold as well if you want, and you can see and you mark all the other pairs you want to compare them with, and it gives you a percentage of how well they correlate to each other. So for example, something like GBPJPY correlates with AUDUSD about 70%. Something like CAD-JPY, because there's that JPY factor in both currency pairs, they actually correlate 85%. Now, personally, I think anything above a 70% or above percentage correlation is a good correlation, is a positive correlation. So just for an example, if you look at GJ correlated with GU, there's an 87.7% correlation between those two pairs, which is a very strong pair. So if you're actually comparing the two charts between GU and GJ, then if they're moving in the same way, and if they're not, you'll be able to actually identify that convergence or divergence, if there is any, that actually exists in the charts. So that was just a little bit on forex correlations and how you can actually see that for yourself. And also, if there is divergence that is identified in the marketplace, then this suggests a bearish price action to follow. So you're going to be looking for those bearish movements, those sell scenarios. And if there's convergence, this suggests bullish price action to follow, which obviously you're going to be looking for those buying scenarios. So that was the theory out of the way, but now let's actually look at some chart examples as well. So as we can see here, we've got GBPUSD in the blue chart and EURUSD in orange. And we know that GBPUSD and EURUSD correlate, which means they're going to be moving in very similar ways. And as you guys can see, as one of them increases, so is the other one. However, at certain times, when actually comparing the market structure of both pairs, and as you can see, I've changed the chart to show a line chart instead to make it a lot easier for us to see the actual market structure. Sometimes you can see that both pairs trending in the opposite direction at the same time. So in this example, you can actually see in blue we have the GBPUSD chart making a lower low, where I've actually drawn a black line. So on here you can see it's making that lower low right there. But at exactly the same time, we see EURUSD making a higher low. So at the same time, down here on the EURUSD on the orange chart, we can see it making a higher low at that exact same time. But you should be asking yourself, surely if these two pairs correlate, they should be having, the same market structure. Now when this happens, it's known as a convergence. As you can see, the two lines which I've drawn are converging. They're basically sort of pointing towards each other. Once you've actually correctly identified convergence, we actually expect to see a bullish price action. And as you can see from the image, both pairs saw a rally in price following the convergence. So once you've actually identified the convergence, you see the two lines sort of moving towards each other, they're converging towards each other. You've correctly identified convergence, and that leads to bullish price action, so you should be expecting buy scenarios. Now here we actually have an example of the opposite. So here we have price divergence. Now again, in orange we've actually got NZD/USD, and in blue we've got AUD/USD. These are the two correlating pairs. Now in this scenario we can actually see that NZD/USD has created a higher high. So you can see NZD/USD in the orange created a further higher high, but AUD/USD created a lower high. So the AUD/USD in the blue chart, you can see it's actually created this lower high right here. And again, notice how the two black lines which I've drawn to identify this difference in market structure, they're diverging away from each other. They're pointing away from each other. Therefore, this shows price divergence. Now again, same as before, once this has been identified, we expect to see a decline in price. And evidently this can be seen from the actual image you can see here. After the divergence was successfully identified, we can see a decline in price. So the second type of divergence that we can sort of identify and analyze is what's known as oscillator divergence. And this is when you can actually use an indicator. You can use a certain oscillator such as the MACD or the RSI. Now by comparing the raw market structure of a currency pair and an oscillator such as the MACD or the RSI, we can determine whether price is converging or diverging. And again, just as we saw before in price divergence, if we see convergence, then we can expect bullish price action and look to anticipate buying scenarios. And vice versa, if we see divergence, then we can expect to see bearish price action and look for selling scenarios. Now MACD actually stands for Moving Average Convergence Divergence. So in my personal opinion, it's probably the best indicator to use to measure convergence and divergence, as opposed to the RSI, which stands for Relative Strength Index. But it is to be known, either can be used. You can use either one. They're both oscillators, so they both have the capabilities of actually measuring the degree of convergence or divergence. But for now, let's jump into some chart examples of this. So what we have right here is GBPUSD on the 15-minute time frame. And what I've marked out for you guys is actually the way you can actually add on the MACD is because I've already had it saved on. Normally once you've got it saved on automatically, you can just double click on the chart background and it'll pop up in the bottom corner right here. But if you don't have it already added on, you go to this little FX Indicators and Strategies tab right here. Click the favorites, it'll be on your favorites. If not, you want to click that, quickly type in MACD, and it will just be the one that says MACD alone. So that's how you can access the Moving Average Convergence Divergence Indicator. And just looking at these chart examples right here, which I've got for you guys, look at the market structure for GBPUSD right here. You can see GBPUSD here is creating that higher high. You can see the blue arrow is pointing to the upside, but at the same exact time on the oscillator, on the MACD, you can see it's created a lower high. The arrows are moving away from each other, they're pointing away from each other, they're diverging. And after a divergence, what is we expecting to see? Bearish price action. So if we actually move across, we can see how price actually decided to move down around 100 pips. Probably even more, around 100 and 140 pips I think it was after that movement there. And there you go. So after that divergence was seen, we were able to, confidently go for certain sell scenarios which would help us capitalize upon this movement to the downside. Then just moving along, and more examples of this. Again, we've got the actual GBPUSD chart creating a higher high, but on the actual oscillator, on the MACD, we've actually got this lower high. Again, arrows are moving away from each other, they are diverging away from each other, so we can expect to see bearish price action. And that is what we get, another decline in price. Now on this one, let's just switch it up to the 5-minute time frame. I think it'll be easier to see on there. And there we go. Now in this scenario, we've got the opposite. We've got an example of a convergence. So here we've got the market making lower lows, but the oscillator, the MACD, is making higher lows. The lines are moving towards each other, and as you can see, they're converging, and when we see convergence, we expect to see bullish price action. So as we get out of replay mode, we can see obviously where we saw that first incident of convergence, which I believe it was in here. So after we see that convergence, what do we see? A big incline of price, a big raise, a big rally in price. And this is all on one pair, which I've just, quickly looked for chart examples on. And again, you guys are starting to get the picture by now. I think, you've got a lower low being created on the chart, but at the same time on the oscillator, you're getting a higher low. And that's what's known as convergence. Arrows are moving towards each other, arrows are converging. So we're expecting to see bullish price action, and that's what we get. We get a big incline, a big rally of price. There's countless examples of this actually happening within the actual markets. So now we're actually going to be looking at how we can incorporate, this convergence, divergence, confirmation within our Wyckoff schematic confirmations as well. Now, when it comes to Wyckoff schematics, we know that following an accumulation, we see prices rise, and after a distribution, we see prices fall. And now, after what we've just found out, what we've just explored, we also know that once we've seen convergence, we see prices rise, and after seeing divergence, we see prices fall. So using these two facts, we can expect to see convergence at times of accumulation and divergence at times of distribution. Now, when I personally look to trade, I find that identifying these convergences and divergences alongside my Wyckoff analysis to be a very useful extra confirmation, in my analysis, in my trading plan. But yes, let's again look at some more chart examples. So what I've done here on GJ, and again, we're on a 15-minute time frame just to make life easier for ourselves. In these little black boxes, I've marked up some relevant distribution and accumulation schematics. So right here, what we can actually see is, obviously, you can see that price is making these higher movements. So what we've got here, from here to here, we're making a higher high. But at the exact same time on the oscillator, you start from where you found the higher, from the first high to the second high. Look down at the oscillator, and it's actually making a lower high. So we know that we've got a degree of divergence here within the distribution schematic in the box. So we're expecting to see bearish price movement to follow, and we get, that bearish, that downwards movement which we like to see. Moving along to here. In here, we've identified an accumulation schematic. You can see all the different steps: the preliminary support, the selling climax, automatic rally, secondary test, further secondary test. We get the spring break of structure. The whole thing, the whole accumulation schematic is here. But just looking at it in terms of a divergence and convergence aspect, here we've got it. We've got the market creating a lower low, as you would expect. But at the same time, you've got it creating a higher low on the oscillator, on the MACD. So within this accumulation schematic, we saw convergence. So it's like a double whammy sort of confirmation. It just gives you that extra bit of confidence that this accumulation is going to be valid. This accumulation is not going to suddenly change afterwards to a redistribution. So, it's not going to flip its bias, basically. Again, moving along, what we can actually see, if you've not spotted the pattern right now, just keep looking at more examples. But what we can see again right here, we've got the price making higher highs, but the oscillator at the exact same time, it's making lower highs. It's slanting downwards. They're diverging away, and we expect to see bearish price action to follow. What do we get? We get a mitigation back over here of this imbalance fill area, and then it decides to drop, and we get that bearish movement, which we like to see. And again, just a couple more examples just to really train your eyes, guys. So again, we've got this lower low being created in here. On the oscillator, on the other hand, we've got a higher low. Convergence, arrows pointing towards each other. So we've got convergence, and that leads to buy scenarios, and you could definitely see where you'd be liking to get in for these buy scenarios. I believe this may be the last example, but just to really show you guys, how simple it is to really spot these sort of things. Again, what have we got? We've got these lower lows being created, and at the same time on the oscillator, we've actually got higher lows being created. Convergence leads to bullish price action, which is what we go on to see. And again, I think I've marked up a couple more, but might as well just show you, just for argument's sake. Same thing happening again. This one's a very, very good example of divergence. higher highs on the chart, on the oscillator, lower highs, sorry, and then we expect to see a decline in price. And what do we get? That decline in price. And again, right here, higher high, and here we've got lower highs being created on the oscillator. So let's just make it a bit more accurate. It should be there. And then we've got that divergence, and we expect to see a decline in price, and that's what we get, that decline in price right there. Now, there is actually one more thing I'd like to bring up regarding actually using convergence and divergence in your analysis or in your trading plan. Now, identifying convergence or divergence isn't enough on its own to form a bias and place trades upon. Now, I actually personally look at it as an extra half of a confirmation. Essentially, it's just there to give me more confidence in my original bias if the convergence and divergence is there. Now, I'm actually going to be showing you some more chart examples now and certain scenarios as to why divergence alone can't be used just to form your entire bias. So the first example that I've got for you guys is going to be on GBPJPY on the 5-minute time frame. So I'm actually just going to jump it into replay mode so we can jump down and not lose our spot in the charts. And let's cut the chart back just to see how it would look if we were actually analyzing this live. So obviously at this point here, you're looking at the market. You can see that the actual price action, the actual market structure of GJ right now is creating those higher lows and higher highs. It's still creating those high highs, so we've got an upward slope on the top there. And then as we look at the MACD at the exact same time, what have we got? We've got the downward sloping market. So it looks like we've got a really good example of divergence in this case. So what do we do after we've seen the divergence? You want to be monitoring the price action, and you want to be waiting for that break of structure. And in this case, because it's divergence, you want to be waiting for that break of structure to the downside and then waiting to get your entries in. So as we actually forward the price, there we go. We've got a nice break of structure in this moment right here. And then it's a case of, if we're going to go for this sort of entry, having our entry at the imbalance fill, obviously we could have our stop loss over here at the high. And obviously wherever we're looking to target, we can look to target. But as we actually forward the price and see what actually happens, so obviously we're getting into the entry right there, but looking at how price progresses, it's going against our favor. It's going, against our sort of bias that we want it to go for. And as we forward the price, we can see that depending on your spreads, you're definitely being stopped out in that moment right there. So that just shows that alone, divergence alone is not enough to sort of base your entire bias on. In this particular scenario, it was a case of waiting for this whole distribution to actually play out and form. So it's a case of combining the MACD divergence confirmation that we've learned today in conjunction with actual Wyckoff analysis in this scenario. This was just the first part of that distribution cycle. That's that first part. So we've got, the preliminary supply, buyer's climax, automatic rally, secondary test, and this was the sign of weakness. We then go up to get more secondary tests, creating equal highs with this previous wick, as you can see, and then we get that manipulation up, that break of structure down. You can see it's broken structure below this point right here, and then you'd be good to sort of place your entries at this sort of level, stop loss at the top, and obviously targeting wherever we want to look to target. And as we forward price, we're getting in the entry right there. So let's move it across so we can see. And as price goes on, that's when you sort of need to be looking to get into these positions when you're looking at divergence. That alone, having just seen the first part of that divergence, is not enough. It simply is not enough to base your trades upon. You need to have this MACD sort of convergence confirmation in conjunction with other confirmations. And in this particular scenario, it was all to do with the full Wyckoff schematic being printed out. Now, the second example that I've got for you guys is on GBPJPY once again, but this time it's on the 15-minute time frame, and this time we're going to be looking at this potential example of a convergence. So as we can see right here, I'm going to cut the chart off once more just to see how it would be like if we were analyzing it live. And right here what we've got is the market creating those lower lows. So we've got the market creating those lower lows. It's a downward sloping market, and as we compare it with the actual MACD at the exact same time, we can see the MACD is actually sloping upwards. So we've got those making higher lows. So that there is confirmation that we have convergence. It's a positive confirmation of convergence, but that alone simply isn't enough to base our entire bias on. So what we need to do is wait for that positive break of structure. If we were to just trade off of this, say we saw the convergence and we look to place our buys, say we just market executed, had our stops at the low around there, and obviously we see how price would have played out. You know, it's battling, and then obviously our stop losses eventually hit. And as we forward the price, we can see why that simply wasn't enough to see that convergence. That wasn't enough just to go for the buys, because look at the market structure. At no point after this convergence was there a break of structure to the upside. We didn't really account for any sort of market structure in our confirmations. Now, the moment where we see the break of structure to the upside is right here. You know, we can see the market here is creating a lower high, lower low, lower high, lower low, down in here, lower high, and then higher lows. So having seen that, then you'd be looking to place your buy entries roughly around these levels here. Stop losses at the low, and then obviously looking to target wherever you want to be looking to target, probably top of the range right there. And as we forward the price, let's move this along so we can see. So as we forward the price, there we're getting entered in there, and then we get that bullishness which we were expecting to see in this scenario. There you go. As we see, we get that bullish price action that we like to see after a convergence. Now the final example which I have for you guys, and you can probably see it already from here, what I'm going to be going over for this last final example, it's going to be on GBPUSD on the 30-minute time frame. And again, I'm going to chop it off right there so we can see what it would be looking like if we were analyzing live once more. Again, higher highs being created on the actual chart, on the price action, but on the oscillator, on the MACD, we're getting lower highs. So it's a good example of a divergence. So we should be expecting some bearish price action. Again, when we forward the price, we can see obviously if you're basing trades upon this, you'd be looking to place any sort of shorts. You've got a nice buy to sell candle right in there. So say this was your entry, having your stops at the high, and then TPs wherever we want to have them at the lows, and then forwarding price, you know, we're getting that good movement. You know, it's looking like it's going in our favor, and then it reverses, it takes us out. It takes us out, and look at the market structure once more. It just wasn't there. You know, this market structure, it didn't really break to the downside in that moment. And then we basically have seen right here, there's a liquidity grab above these highs, and then it really shows us that true direction we want to see. And as we forward the price, there we have that positive break of structure. So the position that we should have actually looked to play would have been roughly around this sort of area. You know, obviously we'd be looking at these sort of areas in here, anywhere within this sort of point of interest, I'd say. So anywhere within this sort of point of interest, we'd be looking to take any sort of entries for that. And as we forward the price, we'll see how it would have played out eventually. Getting into the entry right there. And then having that downwards movement which we like to see. So there would be that sort of successful sell scenario which we'd be looking at. So as you guys can see from just a couple examples which I've shown you right now, this definitely shows why having convergence and divergence alone is not enough to have a full bias on a trade idea. So there was actually how I like to personally identify and use convergence and divergence in my trading plan or analysis. I hope you guys really enjoyed the video. If you did, please do give it a like. And if you guys learned something new and took value, please subscribe and share as well. Thanks for watching, guys. I'll see you guys in the next video for more of that trading source.